Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guest and I will cover all angles of real estate. We're back in the saddle here for the new year. Obviously, we had the holidays. We had a little time in between where we haven't had a podcast for the last 2 weeks, but we wanted to get back. We have so much content to cover today. There's been a lot taking place, obviously, in regards to real estate, the economy. We want to dive really deep. We're going to give you our predictions for 2015, real estate, the economy, the Fed, gold and silver. So you definitely want to stay tuned in. I think we have a pretty good grasp on what's been taking place here. As we've mentioned, that pretty much everything is dictated by the Fed these days. So hopefully our predictions are sure to be right this year, and instead of sure you're wrong. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert in Inman News, Wall Street Journal, Forbes, Fox Business, U.S. News, MSN, and numerous others. Louis, how you doing today?
I'm doing grand. Happy New Year to you, Ryan.
Happy New Year to you as well. It's
Thank you.
Obviously, as we head into 2015, there's been a lot taking place. We've most recent, Obama went out to Arizona to give the grandiose real estate speech, and it's interesting because I believe he was there the last time. It was back in 2009. I can't even remember what year it was when he went out there when real estate prices were really depressed in Arizona. And now he just happens to make his way right back out there where prices have increased over that period of time, claiming that he can do more for housing. And through executive action, he can come in and say, FHA, we need to lower our annual premiums from 1.35% to 0.85%. Now, you and I have talked for some time, Louis, that for an economy that seems to have been moving in the right direction per Congress, per the president, and per the Fed, it's interesting that you would need to make a move like this. I mean, everything has just been peachy. Why do we need to do anything? Why do we need to tinker with the economy that's already been moving in the right direction? As you and I mentioned, it's been a complete con job on the American people, in my estimation. It's keeping them completely confused. Now what they're going to go back to doing is trying to put people into a home that don't deserve to have one. And by as I said before, loosening underwriting guidelines, by making it easier for people to get a loan, because guess what? There's not enough people buying homes. They're really worried about that, by the way, and you and I have noted over the last 12 months that we've been seeing properties starting to sit on the market and inventory is starting to build with a low interest rate environment, which is kind of counterintuitive to a solid economy, right? I want to get your take first on obviously the timing, the new year of Obama coming out and trying to give the rah-rah speech to get housing moving in the right direction. We'll then dive deeper. You can go ahead and give your prediction for where real estate is headed this year in 2015, as well as mortgage interest rates, and then I'll chime in after you give your 2 cents there.
All right. Thanks, Ryan. Well, I'm just finishing up a piece, excuse me, which should be up while this podcast is up, called The False Housing Recovery of 2014. And if you recall, Ryan, I wrote one called The False Housing Recovery of 2013.
Yeah.
And I basically am looking at the housing market and seeing that there's been no change other than in rising prices. 2013, you saw double-digit price appreciation nationwide. Last year, 2014, we saw single-digit appreciation. And this year, I would expect that you probably can't get much higher in appreciation. But the prevailing theme the last 2 years during the so-called housing recovery has been declining home sales, existing home sales, declining new home sales, declining new home starts, declining permit applications for new homes. We've continued to have the burden of the student loans and the lack of opportunities for millennials. It's just basically, and you've got lower mortgage applications, and everything I just mentioned in 2014 was lower than 2013. You've got stagnant wage and job growth, although they've been saying, Ryan, and this is the difference between 2013 and 2014. In 2013, they were talking about, once the wages and the jobs start to pick up and the economy starts to accelerate, this real estate recovery will move forward. And once we've got more inventory. Well,
right.
We got more inventory, and we did not get more housing sales. We did not get more mortgage applications. We got fewer. And what happened with the economy was nothing really happened. We gained jobs, but we lost full-time jobs. So every time they produced a non-farm payroll, and they've got one coming out today, these numbers are getting for 250 to 300,000 jobs created, but no one is mentioning, Ryan, except you, me, and a few others who actually read the Bureau of Labor Statistics report, not just the headline that they put out, that those jobs are created, not only are they low-paying jobs, mostly in the service sector and so on, but they are net of full-time jobs lost. So, for example, they may create 800,000 part-time jobs and lose 500,000 full-time better jobs and claim, hooray, we've made 300,000 jobs in this month. That shows that there's a recovery. You hear Reuters talking about solid job growth. That's the word they use constantly. Everything is solid. Bloomberg likes to say things are robust. But those 300,000 jobs not only are not good jobs, but where are they going to, Ryan? They're going to almost all of the job growth. I think about 80% of it, of those additional part-time jobs, are going to people 55 years and older. And
right.
People that are 55 years and older, they don't buy houses. A few of them go into these new communities, the active adult communities, but that's not real. The real growth in housing has to come from. The growth in housing has to come from millennials. Well, in that age bracket, job growth is basically non-existent, and the jobs that they are getting are those part-time jobs, and they have still the student loan issue. So you can lower, and interest rates, the other thing that happened in 2014 was interest rates right now, at the end of the year, at the end of 2014, every metric in real estate was lower other than prices were slightly higher. You had lower interest rates, you had lower pending home sales, you had lower existing home sales, lower new home sales, and now they're talking about 2015. If you look at, I compiled a bunch of the mainstream media's outlooks, Bloomberg, they're saying young home buyers, Ryan, they're returning to the U.S. as the economy accelerates. Well, and they say an increase in first-time buyers whose market share dropped to a record low last year will provide a boost to the sluggish mortgage industry. So they're just predicting it as if it's a fact, and it's going to happen. Not would happen, could happen, but will happen. That's what's going to happen in 2015. They've decided for years that millennials who have been stuck in parents' basements are suddenly going to emerge, and they predict this every year, in 2015 and become home buyers. Then you have CNBC, Real Estate Pros 2015 forecast, Axis of Housing Happiness. Here's one of the guests they have on there. I call it the Axis of Housing Happiness, in that you have jobs, you have low oil prices, which we'll discuss a little later on, and you have low interest rates. Therefore, totally oblivious to the problem that low oil prices might have on the economy and housing. And you have these low interest rates. Well, we've had them all year. That's not going to help. But somehow that's the Axis of Housing Happiness. Reuters, improving labor market, low mortgage rates, same thing, and stock market record highs boost 2015 outlook. And that's according to none other than Lawrence Yun, the National Association of Realtors. Business Insider, why it will be easier to buy a home in 2015. Economic recovery and an improving job market will go a long way to boost affordability. Okay, what all of them are missing, Ryan, and this is my prediction for real estate, is you cannot push home prices higher. Higher home prices are not good for the, quote, housing recovery. The only way you can improve affordability, you can do it one of two ways. You can increase jobs and wage growth, but there's no way we're going to increase jobs and wage growth 20, 30% in the next year. So really what has to happen is home prices have to come down, and what we want are lower home prices to boost demand for homes because you have increased inventory coming on the market. But it's a tough trick to pull off because if you lower home prices, more inventory is not going to come on the market because people won't sell. So I think what they're going to do in 2015, they're going to try to push this, as you say, with Obama and his let's lower the insurance costs. Who knows what the Fed is going to do. And then, of course, you've got that Fannie Mae, Freddie Mac 3% mortgage down. So they're going to try all these tricks to kind of reflate something, a balloon that has a lot of holes in it. I don't think you can get much more higher sales or higher prices in 2015 in the current dynamic. What they have to do is basically let the market flush itself out and eventually reach the price levels that make sense. And then people have to get jobs, and if they get jobs and they're doing well, they'll buy a house. But all these artificial stimulus things have now run their course. Remember, the biggest artificial stimulus that's been put into this housing market is $4 trillion worth of QE.
Right.
Okay, so you did that for 5 years, and now you're still scrambling. You're calling it a recovery, but they're still scrambling to find a way to boost housing.
Yep.
And they come up with these little tricks. So I really don't think you're going to see much improvement in housing in terms of home sales. That's, to me, the most important thing. Existing home sales, and even more important, getting more new construction, because new construction is at 30 and 40 years lows. It's under 500,000 new homes on a seasonally adjusted basis at the end of last year, and that's way too low. And those are the jobs, that's the area of housing that actually creates jobs, construction jobs. And we don't have that, and you won't have that in 2015.
Well, it's going to be interesting. You're going to be probably surprised by my prediction. And you might want to call me a conspiracy theorist because you already know my thoughts on the play for the next presidential election, right?
Yep.
I've been watching the 10-year note, and I follow a couple people, but one in particular. His name's Barry Habib. He's an analyst of mortgage-backed securities, and he's been following this for some time. And he actually predicted about a year or so ago that 10-year note was going to drop below 2%, and did it, and was correct in that. He does
when no one else was. When everyone else was predicting higher when the Fed pulled QE.
Absolutely, which already means that he's a contrarian, which is why I like him, right? So he has now came out and said that there's potential for the 10-year note to go below 1.5 and maybe even close to 1%. Now, why do I think that's important? Because I think with all the economic crap that's going on all over the world at this point, the dollar is starting to see a lot of strength now, and there's been a lot of events taking place, namely oil, and I feel like with all these creative programs that are taking place, I do agree with you prices. I don't believe prices are going to move up much, mainly because of there's not really any increases in wages, right? We don't really have that. There's really no stability. But what I'm seeing is that they're just getting creative on the other side, which you mentioned, creative financing options for lower credit scores. Now, all of a sudden, we're drifting back down into 500 levels to be able to get 3% down financing, okay? That hasn't been there for some time. I'm now seeing brokers pop with stated income verified assets, 12-month bank statements programs. Do you know what this is resembling, Lewis? This is resembling the time that we got ourselves into the hole the last time.
Right.
But what's happening is that there's nowhere to turn. And you and I have said this, and I pretty much said this a while back where I was like, okay, well, first off, they were going to bring in adjustable rate mortgages. When they realized that those low rates weren't going to be able to entice people, they're going to have to get more creative and loosen their guidelines even more. Now we have cheaper mortgage insurance for FHA loans, which is now going to put pressure back on Fannie and Freddie because government's going to try to take a share of mortgage loans, and they're going to have to do something. So what's going to happen is that Dodd-Frank that came out with all these regulations is basically going to be taken back off the board. So now regulation goes back away. We create this vicious cycle all over again. What do I think will happen? I actually think that sales are going to go up in 2015, mainly because I believe that interest rates are going to come down. I believe they're going to come down from the levels that they're at now. And the reason why is twofold. A, is they're going to get their agenda of getting more people into homes that probably shouldn't be into homes. And B, it makes the Democrats look great again. Look at the plan they put in place. The economy must be improving. Home sales are up. People are getting into homes. I can see that this could work. Now, you and I would say, well, look, there's a bunch of part-time jobs out there. It's mainly contract work. Full-time positions are falling by the wayside. But if they start to be more lenient where you can now, if you can justify why you had that job gap 3 months and now got into a stable job and you can still get a loan, then that's going to put a lot more people in a position where they might qualify. Now, do I...
Okay, but that is not a housing recovery. That is just giving people houses. and saying, see, home sales increased because we basically lowered the fences, brought the fences in. That's not really a housing recovery.
No, and I don't mean.
But they'll call it that, of course. I mean, that'll be
the rhetoric is going to be that it's a recovery. You and I know that it's an artificial increase in sales, right? By just changing up basically regulations and underwriting guidelines and increasing it that way instead of doing it through the means of organic growth in the job market and wages and the things that should happen, right?
You hit a ball out of the infield, and the new rule is that's a home run.
Absolutely, and you and I have talked about
that doesn't mean the players got any better. There were more. If you predict more home runs in 2015 because the rule is now when you get the ball out of the infield it's a home run, sure, you're right, and if they want to propagandize that there's a housing recovery, but I agree they'll try everything in their power to try to get more people in homes. But as far as on where we are now, everything they've tried to date, they're not going to get any more blood out of the stone. So what you're saying is they're going to create new programs.
Well, it's always been, Lewis, that when we had interest rates in the high 3% range, that I was telling you that nobody could qualify, right?
Right.
And the reason why is because of jobs or dinged credit and all these other things. And I was telling you, I don't even remember what the stat was about a year ago. It was probably like 30 to 40% of all mortgage applications were being denied for one reason or another. Well, if all of a sudden you can take those same mortgage applications and you loosen guidelines to where credit scores no longer have to be at 640 and it can be at 580, and now all of a sudden you can start to make it to where down payment requirements are less or none at all, and then you can have the debt-to-income ratios that are now being expanded out, and then all of a sudden, the annual mortgage insurance is dropped down. When you do all of those things, you're naturally going to get some sort of uptick, right?
But you missed one step before. If mortgage applications are down, it doesn't matter because they haven't applied for them to even take advantage of this. So mortgage applications are down 10%, 9.9% in the most reading on a seasonally adjusted basis. So that's not going to help them unless they do a massive propaganda campaign to get people to apply. Well, they will try for sure.
Exactly. That's what I think is coming, and that's the whole Obama going out to Arizona, talking about this. This is if you remember, you and I had said, why has it gone, real estate and the talk of real estate gone so silent for such an extended period of time, right?
Because it wasn't any good, and they had nothing to say.
Yeah, but now for 2015, it looks like, hey, if we can focus on real estate, we have a low interest rate environment, if we can get more people into homes this year through an artificial means of creating programs that probably aren't really beneficial, and we can get people to say, hey, look, I was able to buy a home this year, they're going to naturally feel good about themselves regardless of what's taking place in the economy. And
if Obama can say he did it himself.
Absolutely. It's another badge he gets to give himself, right, for another thing that he did while in office. And now, do I agree with all this, Lewis? Of course not.
Of course
I just
not.
think that this is
You think it's going to work. I think it won't work. That's the only difference in our point of view for 2015.
And you know what? The only reason I think that it will work is because every time that I said something wouldn't work before, Lewis, it did.
That's true.
Right?
We thought we were right in that QE did nothing for the housing market, but it did boost the stock prices, and people could care less that the reason the stocks are higher because of buybacks and because of QE and low interest rates and so on happened anyway, and no one complained. So, and we also didn't think that they can pull off a 6-year QE program without damaging the dollar, and they ended the QE program, and the dollar is higher now than it was in 9 years before the financial crisis. And so, yeah, you have to give them credit for pulling off these programs.
Absolutely.
But the difference with real estate, though, I think it's harder. You have to get people to actually do something. You have to qualify them. They have to go in, and it's not the same thing as getting people to buy stocks. And you also have to get more people to do it, not just a small number of flash traders and institutions to buy them. So it's a much bigger program than just trying to boost the stock market.
Absolutely. But, you brought up a great point, the propaganda, right? There has to be propaganda out there in order for it to reach the masses, to make them think more about buying, right? All of last year, we really didn't have that. They kept talking about recovery, but they stopped talking about real estate. So nobody was really paying attention to real estate. And I actually feel like that naturally would create a lower demand for housing at that point in time because it wasn't being peddled every single day. But now, the beginning of 2015, look what we have with insurance premiums, and now we have all these lower down payment options. And if you look on Facebook and Twitter and everywhere else, there's so many freaking articles on this stuff. It's driving me insane. But people.
There you go. I mean, they're definitely going to try, but we'll see if they're able to pull it off.
Well, in 2014,
it would be a disaster if they did manage to pull it off, and they got more people in the houses, as you say, are not qualified and shouldn't have a house. It's just going to cause a bigger problem down the road. They don't know when to stop.
Well, I could sit here and probably tell you 4 or 5 stories off the top of my hand of clients that I've worked with in the last 3 or 4 months that deep down I knew that they probably shouldn't be getting a loan, but they were working with another lender that, hey, they said they could get it done, and they got it done, right? And that tells me something right there. Like, I don't ever tell anybody what to do with their money, right? It's their call. It's their decision.
Right.
But when you're pushing debt-to-income ratios that's 50% or higher, and you're getting a loan, and as I always mention, all of qualifying is off of your gross income, not your net income. And I know with Obamacare and the stories that I've heard from people that are having kids lately and having to fork out $8,000 and $10,000, from their wife's pregnancy and all these mounting bills. I know that to have a debt-to-income ratio with your mortgage and all your other bills, and if it's over 50% of your gross income, you're not going to have any money left at the end of the month. You're not.
Nope.
But yet they're giving loans, Lewis, up to almost 57% back in gross debt-to-income ratio. Okay, 57%. Now, if we were really in a conservative environment and we didn't want to really lend to people that we didn't think could repay it, why would we lend to somebody at a 57% back-end ratio? Now, and let's assume that their compensating factors were that they had a retirement account that they had $50,000 in, right? Nobody wants to. If you really consider the retirement account as their backup plan, I mean, they're going to have to liquidate that, and they're not going to want to do that to keep their mortgage. They're not. So,
they'll also have to pay penalties, fines, and income on that.
Oh, absolutely. So it'll be interesting to see how it plays out. I feel like, and I'm going to pay pretty close attention to this, but I think the biggest component is watching interest rates, paying attention to that. Now, I want to kind of segue from there to the good old Fed, okay? And what's going to take place...
But let me just make a clarifying point. Everything we said so far was, as things are, at the end of 2014, beginning of 2015, and we have not yet put into any of the analysis what we think the Fed might do or what impact oil might have on our analysis. So go ahead.
Okay, absolutely right. So as far as the Fed, if their December meeting basically said they could hike rates based upon a core level of 1.4%, as long as it appears that inflation is on its way up to the 2% target that they set, right? Yellen's out there constantly quoted as saying that, well, it appears as though there's no reason for us to speculate that we're not going to start to raise rates sometime mid-2015. But then there's all these other Fed presidents that are out there basically going against her, saying it would be a catastrophe. I believe it was Evans that just came out and said it would be a catastrophe to raise rates up. The reality is, guys, they're not raising rates. They're not raising rates today, tomorrow, 2015, 2016. They can't afford to. We've mentioned this numerous times. What do I actually think is going to happen? QE4, quantitative easing 4. Now, will it happen in 2015? I don't think so. I think that'll be left for the next president to deal with. But you brought up oil, and I think this kind of ties in because oil is the wild card, right? Oil is the wild card because nobody knows how this is going to play out. For those of you not familiar, the oil market, the oil derivative market is huge, right? I want to say it's something like 50 trillion, Lewis. I can't even.
It's ridiculous. 20% of the junk bonds are in the energy market.
And you know what's interesting in the United States, we've had such a huge energy play, right? Like where a majority of I want to say they said 40% of the jobs have been created by energy, right?
And probably almost all of the good jobs.
Absolutely, the good jobs. So now all of a sudden we had oil that basically got cut in half, almost like $100 a barrel down to sub $50 a barrel. Now, many people think that this is some sort of geopolitical play on the part of of OPEC to crush Russia, crush Iran, and as a byproduct, also crush the United States. What's going to happen is in the derivative market, I mean, they're basically option plays. So how long can the United States go at sub $50 a barrel and without these energy companies having to shut their doors? And we're not going to know that for probably the next 3 to 6 months. If oil prices don't rise, if they stay in the levels that they're at now, people are saying that we're going to have to print money in order to start bailing out more people. I want to get your take on that,
either the energy company, but if the energy company is properly hedged, they don't care if the price goes down because they're going to get from their counterparty hedge the price that they locked in. But that means the counterparty hedge is in trouble because they weren't counting on paying that amount.
Well, and they say a lot of the derivatives are these basically huge banks, J.P. Morgan Chase, Bank of America, where they're supposed to be able to keep their investment side and the banking side, separate, but they're now together. So essentially what they're worried about is that if oil stays at these levels and these derivatives came, well, they don't have
to them. Brian, why did they lobby Congress, and Congress went along with it, to allow them to put these derivatives in the FDIC subsidiaries that are, the ones where the people have deposit money, unless they were worried that they wanted some type of bail. And we won't call it a bailout. They're going to say they're covered.
Yeah,
they made an emergency. That wasn't part of a spending bill. The whole point of the end of the year budgetary process isn't to get something in that the banks want. It has nothing to do with spending. They put in protection basically in case something like this happens where they need a bailout and they're not allowed to have a bailout. And they say, well, we have FDIC insurance protection.
Well, and wasn't it just last week that the G20 met and they just passed a rule to basically make bank bail-ins a reality? Did you see that?
Well, they've been talking about that. The U.S. is talking about it. I mean, they know that when you have so much debt upon debt, at some point, they either have to issue more debt and eventually create inflation beyond what they want to create, or they have to start to pay down debt, and they want somebody else to pay it down by not printing money. And they figure, who's better to pay it? Who's better to pay it than the depositor? They got the money in the bank right there. Take it.
Well, and that's my point. So all this oil thing could end up blowing up in the face of the people that are depositing money into the banks, right? It could actually be there's already been word on the street that a lot of these big banks are telling businesses, big business that has money over $250,000 essentially in these banks, to get their money out, Why would they tell
Ryan, it's going to have to happen because, and the other thing about, you're absolutely right about the Fed. They can't raise rates. You're going to have yelling out there talking about considerable period of time. It's quantitative patience. That's what they're going to do all year. She's going to keep pushing it off, and it'll be quantitative patience for a considerable period of time. She's just going to keep pushing it out, and you're right, they probably won't be able to pull the trigger on QE4, but they'll send the signal that they're not raising rates. Right now, they're playing the whole game. Economy's on the up, and we can raise rates, and everybody else is screwed because their economies are no good, and the only way they're going to fix their economy is if they do more QE. Look how well it worked for us. This is the year at some point people realize it, and the Fed can't pretend and the propaganda won't match the reality, that people realize the economy is not doing better. And when you have these shale oil companies starting to go down, there's going to be a huge problem, like you say, with the derivatives. But the other thing is you still have people out there. I think it's very, very simple-minded to call lower gas prices that drop dramatically in 3 to 6 months, a tax cut. That's the most simple-minded thing you can call it. Because first of all, if it does turn out to be a little more permanent, the next thing Congress is going to do is raise the tax on gas to raise revenue. So you'll eliminate that benefit for the consumer right then and there. They'll just raise the taxes, and you'll pay the same amount you paid before the prices dropped. But what they're overlooking now is someone is going to lose big time. And when somebody loses big time, it's not just isolation, right? If countries lose big time because they're relying upon that oil, Russia, Venezuela, whatever, you create internal problems, you create potentials for wars. They need it to balance their budgets, for their import-exports. The United States needs this. as you mentioned, Ryan, you've got all these jobs that were created. You also have this energy independence concept. Well, that's all gone if these companies don't make it. The companies that sell it, they're in trouble. Or they're not in trouble, but the companies that took the hedge on their production, they're in trouble. And as you say, those are the big banks. Well, what happens when the big banks are in trouble? The whole economy is in trouble because we're a financial service sector global economy. And so what's going to happen possibly, Ryan, is they're going to push. If these companies are hedged, they can continue to stay in business, make the banks pay at a loss for their production at a lower price, figuring they're going to hurt Russia doing this, right? They'll continue to force the malinvestment by pumping gas at a loss to pay off the bonds because they can. And then the United States, I think, figures if there's a problem, either they bail out the shale company if they're not properly hedged, or they bail out the banks who have provided the hedge. And this way they can say, we win. Russia can't do this. But what's interesting, though, is Russia just went through a period of time where they had a problem with the devaluation of the ruble. What did they do? They raised interest rates, 17, 18%. Almost sounds like what Volcker did back in, 1979, 1980 at the Fed when they raised interest rates to cut off inflation. They didn't sell their gold reserves. The United States right now, if they had the same problem, we couldn't raise interest rates 17, 18%. So Russia's almost through this issue. Now the issue is going to come back. It's going to boomerang back to us because they've already gone through the period where their currency gets destroyed. They've gone through the period where they've lost oil revenue, and they've learned to deal with it. They've raised interest rates, and they can still do a few other things. They can start to accept different currencies for their oil. They haven't stopped production either. So right now everybody's playing a game of chicken where the price of oil is dropping and nobody is pulling back production.
No.
It doesn't seem like the United States is pulling back production. Everybody's producing it in a race to the bottom. The problem is somebody is going to lose, and when that one entity or country loses big, if it's a country, they can lash out. If it's a bank or a few banks, the whole thing cascades. So that means all of our predictions about real estate go by the way.
The economy. Absolutely.
Yeah, because if you have that type of disruption in the economy, it's not just some benign tax cut where people, we pay $20 less a month for gas. Isn't that great for the economy? No, there's no way that there's not going to be repercussions for lower prices because everybody who is engaged in the oil market and producing at these levels is doing it for their own strategic game theory reasons. Someone's going to lose.
Well,
and you can't have a loser in isolation.
Absolutely not. And you and I had talked a long way back, right? We said that the economy is 100, an artificially built economy based upon the Fed, what the Fed does, what the Fed says, what the Fed implies through their messages and their meetings. And so the markets interpret what they say, and they say, okay, well, if they're willing to continue down this path, then I guess, the stock market will stay propped up. The reason why they'll never come out and say, hey, next week we're going to raise rates, they won't say that. They'll always signal off in the futures because they don't ever want to give any clear intention to the market, because if they do, then they'll know something's up. Well, the markets already know that something's up. The market doesn't have a choice but to go along with it. And this has been going on for years now. I mean, and it's not going to stop. I think that you bring up, a great point. I mean, we always talked about the wild card. There was some wild card out there, some event, some geopolitical event. Well, oil is now that event that's the wild card, right? And
Absolutely.
I don't think anybody, the average American, the only thing that they know right now is that when they go to the pump, now they're paying, sub $2 versus they were paying almost $4 before. So they think,
and what does that translate into politically? Thank you, Obama, for the lower gas prices.
That's exactly my point. So who's going to get
That's
kudos
the
for
only
this?
thing that they get out of it. They don't realize that when oil prices go down, there's also a corresponding decrease in the demand for dollars. No one's even thought about that yet, because now countries don't need to hold reserves in dollars if they don't need that many dollars to buy oil. I don't know where that all plays into it, but you're right. All people are thinking about is, I paid less. It must be because the economy is getting better, because that means I pay less, so it's good for me, good for my economy.
And you know,
and that's good for the Democrats.
Well, and you know who's included in this nonsense is the media. They'll play on it too. Well, it's helping consumers. Look, gas prices are cheap. Yeah, because you know why? The media can't come out there and say, hey, guys, I know you're paying cheaper gas, but you really need to be worried about what that means for the implications of the overall economy, right?
Right, we paid cheaper gas in 2008 just before the crisis. That didn't really help.
Well, absolutely, and I think that, you know, being a realist here, this is not a good situation at all because of the magnitude, the amount of money that's actually out there. And when we're talking about money, I mean, when we're talking about derivative market, we're talking about, you know, like a $50 trillion market. We're not talking – the FDIC insurance fund, I believe, is only like what?
It doesn't cover that.
It's like I think they have up to like $500 billion or something.
No, there's no way it covers an infinitesimal amount. Well, all they would do there is they say, well, now that the banks are covered in this part, we'll just increase the insurance, you know, executive order or something like that. Right. It should be obvious to anybody other than the most diehard CNBC economic cheerleader that gas prices plummeting like this in 2 or 3 months is a very bad sign for the economy. Mostly because we don't know what it means. We know that there's all these moving parts out there, but we know that when there's an acceleration, a deceleration in gas prices, someone's going to get hurt.
Yeah, and
this isn't just a natural market, you know, taking care of itself. This is monopolies playing games and countries playing games with the most precious, because energy drives the whole economy, fuel of the economy.
Well, and it's why Peter Schiff and others are out there saying, well, looks like there's not an option but for QE4 at this point. And for those of you that are new to the podcast and listening, when we start talking about QE, I know that's a term we throw out a lot, quantitative easing. Just think it's just money printing. That's all it is, okay? It's just the Fed deciding to print more money. And it's really not even printing money at this point. It's just adding zeros to banks, you know, balance sheets. That's all it is. They're not actually...
And for our listeners, QE is being done by the United States Federal Reserve, not by communist China, but by, you know, it's state-controlled capitalism versus free market communism. I mean, the United States is the one who is printing money, manipulating markets, and trying to get and dictate a result by doing this.
Yeah, and you know what? You've made a point earlier that they've tried this before and it didn't work, right? So what's happened is it will probably never work. But who will it benefit? It benefits the big banks, the hedge funds, and the people that receive the bailouts or bail-ins.
If they win, they win. If they lose, they still win, as Joe Pesci says.
Yeah, so
they're covered.
What does it matter if big banks lose $5 trillion? Because if the Fed decides to step in and say they can't go out of business, they just can't. We will backstop it, and it doesn't matter whether we're talking about $1 or 1,000 or 1,000,000 or 1 billion or 1 trillion, whatever that number is. It doesn't matter.
It doesn't matter. No, and they can break laws, and if they get caught or if someone decides not. I think the regulators know they do this. They just decide they need some money in the terms of a fine. So that's when they decide to bring the action.
Well, and you know what I think is... Go ahead.
No, I was just saying that the banks can do whatever they want in order to make money as long as they have the regulators and the Fed and the government on their side. So they're basically a quasi-governmental entity that is there to generate revenue for themselves, and they can't lose. They can break laws if they want. They just have to pay the fine. And where does the fine go? It comes out of the shareholder pocket and goes back to the government.
Well,
and does it go to the people of the? It doesn't go to the people. It's not like when J.P. Morgan pays a fine, you and I get a little windfall for them having screwed up some market. No, it goes back into the regulator's budget.
Well, and it's a big joke anyway, because it's just like, you know what? It's like, I'm going to slap you on your hands because you screwed up. So you're going to pay your $5 billion fine, but I know you made $50 billion, right? So they made more money. They made 10 times the amount of money that they're paying out in fines, so it's really irrelevant. But I think
it's like the mafia. The regulators are the protection racket.
Of course.
And they just have to be paid so that the banks can go and do what they want.
And I think the fact that the Fed knows that they've really been unsuccessful in being able to drive the real estate market over a period of time, is while...
Which is not their primary initiative anyway. They really could care less, other than they need to show some... But the reason they did QE was to remove those mortgage-backed securities off of the balance sheets of the banks and out of the receivership of the guarantor.
Yep.
They didn't do it to improve real estate. They did it to basically cover a loss, the government loss and or a bank loss.
Well, but you know as well as I do that it's just what's the perception out there, and when you have tons and tons of foreclosures out there, it doesn't look good, right? So what they try to do is they create an environment, a low interest rate environment, hoping to suck up a lot of these homes, and that worked for investors, right? Investors did that for some time, but now, as you and I have talked about, what's going on now is investors are getting back out of the real estate market because they're realizing that there isn't that appreciation. There isn't.
No, because people can't afford to pay it.
Right, and the banks are not giving the same deals that they were giving years ago at this point. So what is happening, in my estimation, is that the Fed has gone to essentially the president and his advisors and said, look, I know that you want to promote essentially home ownership and all this stuff, but really the only way that you're going to accomplish any of that is to deregulate even further. And basically all that really means, guys, is they have to make it easier for people to get home loans, lower credit scores, create more programs, lower insurance premiums, and make it so that people that couldn't buy a house today can buy a house tomorrow. So Ryan, your prediction is that all this is going to lead to not real estate nirvana, but more home sales. And, maybe there'll be a point during the year where it's apparent that your theory is taking hold, people are buying more, and then the oil stuff blows up. Yep.
Stops everything in its tracks. And what do? They just blame Russia. They blame somebody. And they say, see, it was going well. Blame Republicans. I don't know. Somehow you find someone or something or some country that somehow threw a monkey wrench in your wonderful real estate plans, and your economy was growing. Your economy was accelerating. Jobs were plentiful. Real estate was coming back. And then, whoever the boogeyman is, this happened. And because this happened, what do we have to do? Well, we've got to jump in again. Either lower, go to negative interest rates, or QE4, whatever it is. So they always have in their back pocket the excuse to do whatever they want. Yep. But they'd rather not just come out today and do QE4. They'd rather say, we were never going to do QE4, but this was an extraordinary event, and we were forced to do it.
Right. Well, and you know how we always
it's just like somebody who has to have a cigarette. I didn't smoke for 3 weeks. And then, something happened. I lost my job. Well, I got to smoke.
Right.
And that's basically what the Fed is. They have to do QE. They just need the excuse. They have to keep rates at zero.
Exactly. And
whether they use QE or not, they have to keep rates at zero.
Well, what was the mantra during the financial crisis? Basically, desperate times call for desperate measures, right? So they can say whatever they want to say right now. But if the oil crisis does unfold the way we think it could, they will be forced into printing money. There's no way around it. They
know it's going to happen, Ryan. That's why the banks put that provision in to the spending bill at the end of the year.
Yep.
Why else would they do that?
Well, because they have to find a way to protect themselves, right? And
why else would the Comex put in these caps on prices going higher for gold and silver? Because that's the first thing that's going to happen if the oil situation blows up. People are going to rush into the safety, perhaps of the dollar, but definitely in gold and silver. And you don't need that many people to buy gold or silver for the price to go high, especially silver.
Right.
I mean, the annual output is about 1 billion ounces. If you're selling it at $15 an ounce, it's only $15 billion, and you don't buy all that. Half of that goes to industry. So now you're talking $6 billion worth of silver, $7 billion worth of silver. It only takes a slight uptick in interest for that price to skyrocket.
Yeah, so if what I hear you saying, there's probably maybe a 50% shot that this oil thing just blows up this year and QE4 happens.
Yeah.
Is that what you're thinking?
That's what I'm thinking, that the best plans, mice and men in real estate, I think absent QE4, absent an oil issue, that this wouldn't work anyway. There's only so many times you can try to reheat the souffle.
Hey, I've heard you say that before.
And there's holes in the balloon. You can only pump so much air. You can pump more air, and what's going to happen?
Yeah.
Well, so we'll see. But I think that's what makes it even more unlikely is you've got these other events. The oil thing is out there. Prices are not going to rise anytime soon. Saudi Arabia is on record saying, I don't care. Prices go to $20. We're not reducing output.
Absolutely.
When you say something like that, you're saying, I don't care. I have other interests in mind other than making my profit now.
Yep.
I can wait. And when the United States shale company, they can't stop producing. They have to pay their bonds.
Yep.
And they're probably told, keep producing.
Yeah.
And the only reason they'll stop is if their hedge is going to be in trouble because they're producing too much, and the bank has to cover the spread between what they contracted for and what they're actually selling it for. Someone's going to lose.
Well, and they're playing the long game on us, and it's gonna work. I mean, you can already see the effects of it. And
if the United States actually, you pointed this out last week or 2 weeks ago, it was 2 weeks ago because we didn't have a show last week, that if the United States shale oil business industry was so severely damaged by the low price, let's say they took the losses and not the banks, or a combination, the banks take some losses and the shale industry takes some losses, eliminating those jobs, eliminating energy independence, eliminating all the benefits of that industry, well, they'll bail them out.
Yep. I just wish that I could somehow find a way into being on the receiving end of a bailout. Like, you know what I mean?
No, you know what the best thing about the bailout is? You know before you start that there's the bailout put.
Yeah, it's already there. Like, and you know that if your company succeeds or fails, it doesn't matter. I mean,
it's like when you're in a dream and you know you're invincible and you can jump off the building and you can fly and you can do whatever you want.
Hey, Louis,
but you know it's only a dream.
Right. Well, I mean, it'd be great to go to work every day knowing that it doesn't even matter what happens. Right? It's like, hey, I could win. I could lose 10 of my clients, but I don't care because I got this guy over here that's going to give me money when I lose it all. So what does it matter?
It's basically they have your bank account details and they wire you the money no matter whatever your performance is.
And I think this highlights the fantasy world that these banksters get to live in. I mean, it's really insane, and none of us, the average Joe, can really, I don't think quantify like the magnitude of what's taking place. Like it's insane. Like and they're so far into it, as you and I mentioned, they can't start over. They can't reboot. They're done. It's just a matter of.
And the problem is they call that capitalism, and they call it greedy capitalists. And now you get socialists saying we've got to change this. No, these guys would have been out of business long ago if they took these reckless bets and lost. Yep. I think if somebody is a banker and through honest insight and deal making figures out a way to produce profit, either through putting companies or whatever it is, I don't care if they get paid $5, $10, $20, $30 million in bonus. That's capitalism. But if the way they do it is the government backstops every last thing they do, they trade, they win, they trade, and they lose, they win anyway, or they just rig the market and they win that way, they don't deserve a dime of that money.
Yeah.
I mean, if all you have to do is pay a fine, I will take all the bets and I will rig any market as long as all I have to do is pay part of my profits.
I know.
Well, that person basically, you talk about tax rates on the rich, that person should pay 100% tax because the money that person made wasn't earned. It was stolen.
Yeah. It's
now, if somebody actually makes a lot of money, I don't think you should tax them 90%. They actually did something. They earned the money. Why should they hand over 90% of their money?
Right.
They didn't steal it.
Well,
and most of the people who make big money, Ryan, are not people who are doing – even the people who make money, creating these startup companies, they're really not doing anything. They're basically selling an idea to Wall Street. Wall Street makes a lot of money. The company makes nothing. Company's listed for 10 years, makes nothing, but the stock price goes up, so Wall Street's loving them, and these people make a lot of money in stock options. Well, they haven't really produced anything.
But Wall Street's been living in a fantasy world as well, right? There's this huge false sense of reality everywhere. I mean, you look into the stock market and you'd assume that everything is great. You look at Obama on TV, and now it's going to homes and housing. It's going to be more affordable. It's going to be easier for you to get a home. You look at the Fed, and they're talking about, oh, we're going to start raising interest rates. So when you look at all this stuff and you don't ask better questions like you and I do on this show every week, then the answers you're going to arrive at is that the world's not caving in. Except what will happen.
And they don't have to, because what they'll say is everything was fine when they write the history book. Everything was fine until this event happened. When it wasn't fine. And the reason the event happened was it was planned.
Right.
They're purposely doing this. I saw an interview with Obama with National Public Radio, and he said the reason the price of oil is going lower is we know, and we'll put a link up to this, we know that Russia is relying on oil. And this is a way of getting them. So it's not like they didn't plan this. And if it goes, and it could, they could play it right, and it could only harm Russia, and they can somehow get away with not much collateral damage in this shale oil price wars. But if they don't, well, they'll say, well, the economy was doing great until this happened, and we couldn't even expect this to have happened.
Yeah.
And as you say, drastic times require drastic measures.
Absolutely. And we will have to wait and see. I probably still will stick to my original prediction on the whole Obama thing. Nothing bad's going to happen on his dime. I think that they find a way. I don't know how it's done. I do agree with you at some point that the bubble bursts. I just don't know if it's this year. I think that where there's a will, there's a way. They've proven that for countless years now. And I just have this weird feeling that they'll figure it out again, and it'll get us to the next election. Now, I feel bad for the next person, which is more than likely going to be Hillary, because I don't know what she's going to be able to do. She's going to come right in and walk into mess. But that's where
you think it'll collapse on her dime?
I think it's collapsing on whoever's next, and it doesn't matter who that person is. But moving over, we've got about 5 more minutes. I want to touch, where do you think gold and silver prices are going for 2015?
Well, last year I predicted, I think I said silver would be 32 and gold would be 1550. And that was all based on a supply and demand analysis, which turned out to be 100% correct. So I was right about the supply-demand analysis, wrong in the price. Silver went into deficit again in 2014, which means that the supply was lower than the demand. We had record Silver Eagle demand, 44 million Silver Eagles sold. Now, of course, the demand, that's only about 5-10% of the overall silver demand, but all the other metrics of silver demand were higher in 2014 and 2013. Supply kept up, but still was in deficit. And the only reason supply kept up, and I don't think it'll keep up in 2015, is because earlier in the year, the mining companies are making a bit of money because the price was in the 20s. Towards the end of the year, they're losing it. They won't continue to lose money in 2015. Now on gold, it's the same thing. It's the year of Rick, Russia, India, and China. 2014, we saw tremendous increases in Russian buying. They bought 150 tons in 2014. India, even though they had import restrictions, purchased a lot of gold. China, too. The demand was there for gold. The demand was there for silver in 2014. And the price dropped. So you could say it's manipulation. So what I would say, rather than predicting a price again for 2015, I would just say I expect silver demand to increase, supply to decrease. Now, take from what you will from that the price should go higher, but it may not. Same thing for gold.
Yeah, I agree with you, and I think that it is important now that we pay less attention to price because of the manipulation that takes place. I am on those same wavelengths, although I have a feeling that the price will end up hovering somewhere around that $1,200 range for gold. I don't really see it going too far out of sight. They have such mass control on it that I think it will hover somewhere where it's currently at now.
And Ryan, it did go up against every, I don't know if you saw the blog post they put up 12 charts. Gold went up 12% against the euro, 12% against the Japanese yen, 8% against Canadian dollar, 5% against the British pound. It was only down 1.8% against the dollar. And if you looked at the beginning of the year predictions of Goldman Sachs and the other bullion banks, they were talking about $1,000 and sub $1,000 gold price. So gold held up pretty well in 2014. Silver didn't, but that's always the case.
Well, and so here's my big theme of predictions for 2015. We have lower mortgage interest rates. We have housing sales that are up, but up only because of deregulation and increased programs to people that should be having houses to begin with. We have the oil crisis that's looming. That's the big unknown, right? And an economy that continues to be built around the Fed, right? That is artificial. That's manipulated to the max. And it's just, what else can somebody pull out of their pocket to continue this thing down the path that we've been going for 5+ years now? I don't know.
And they always come up with something.
Yeah, and each and every week they give us more material to talk about. So I think moving forward to 2015, the overarching theme is still the Fed. What is next? Is it QE4? Is it money printing this year? Can they get around this huge oil potential bubble burst? I don't know. We'll have to stay tuned. So just give me your quick summation of your themes for 2015 predictions.
The quick summation is, I agree with you, it's the Fed. It's the concept of quantitative patience for a considerable period of time, because that gives the Fed the ability to not raise rates at all depending on what's coming down the pike, and it gives them the opportunity to reverse course if some black swan, or whatever you want to call it, comes up where they have to then turn the printing presses back on. They're not planning on it, but if something breaks down, that's where they've always gone to. It's not like they did QE1 and stopped. They did QE2 and stopped. They did QE3 and stopped.
Right.
Britain's easy. They've done it 3 or 4 times. They'll do it again if they have to. It's a proven now part. It's not just an experiment. It's part of central bank. Just like bail-ins will become part of the financial system. Bail-ins and quantitative easing are part of prudent central bank policy. You look at Abenomics. ECB is trying to get it done, but Germany's trying to stop them. But eventually, it'll be considered standard practice to do QE and to do bail-ins.
Yeah, I agree. Will the wizard show his face this year?
No.
It'll be interesting to see how it plays out. But I appreciate you, Louis, coming on as you always do. If you wouldn't mind, give our listeners your blog post, because, over the last couple of weeks we've been off on holiday vacation. I want to make sure everybody catches up.
Sure. It's smallgold.com, SMAULGLD. On there you'll find analysis of real estate, gold and silver, the Federal Reserve. So please check that out at smallgold.com. I got some good charts up there on the gold to crude oil ratio. I don't know if you saw that, Ryan.
I did.
That ratio is way out of whack. You've got I got the Perth Mint gold and silver sales, the final U.S. Mint silvers and gold sales, gold versus world currency. So those are just some of and also the Shanghai Gold Exchange completed a very good year of delivering physical gold over there in China. So those are all on the front page right now, so please check them out.
Great. Thanks, Louis.
Thank you, Ryan. Happy New Year, everyone.
Happy New Year. Thanks, guys, for tuning in. If you'd like, download, subscribe, share the podcast on iTunes. Search Real Estate 360. Leave a review. If you have any questions, you can go to the website, realestate360live.com. On the right-hand side, there's an Ask a Question button. That's the easiest way. You can also stream all the shows on that website if you don't have access to iTunes. But please leave us reviews. Ask any questions that you have. If you'd like for there to be certain topics covered on future episodes, we'd be glad to do that. Thanks, guys. Take care. Until next week.